SCHD hit a new 52-week high on July 17th. I didn't do anything to make that happen. I didn't time it. I didn't move a single dollar. SCHD's position is up $103.02 right now, and that is a 6.24% gain. It sits inside of $11,511.09 portfolio. Welcome back to another episode of Almost Wealthy. This channel documents my real money journey to becoming my own bank, borrowing against my portfolio instead of my paycheck, using margin to cover my bills while my investments keep compounding. This is my bill stacking plan, the roadmap, and my source of truth I follow phase by phase, and everything you see is live and real. Right now, I'm in phase 2 currently. Now let's get into it. The gain is nice, but it's not the reason my portfolio is bigger. The reason is boring. It's the same reason every single week, whether the market is up or down. Today, I want to talk about the reason I think most people skip right past it, looking for something flashier. It doesn't get its own headline. It's not a stock pick. It's not a secret, but it's an actual cheat code. And I don't think enough people are taking it seriously. The economy doesn't care about your feelings. Before I get into what that discipline actually looks like, you need to see the conditions it has to survive in. Let's look at where things actually stand right now. The Fed meets again on July 28th and 29th. The odds of another rate hike are about 50-50. That matters to me directly because I borrow against my portfolio instead of my paycheck. My margin rate is 5.65% today. If the Feds hike, that rate can move up too. I've only got $443.26 borrowed, so a small rate. A move barely touches me, but later, a bigger phase of my plan, that same percentage moves means real dollars. That's actually why the habit has to start now, why the stakes are still small. On top of that, the rate risk layoffs are still happening across tech, finance, logistics. Inflation is still elevated. That's exactly why I don't want my bills sitting in one singular income forever. A paycheck is one point of failure. A paycheck plus a portfolio that can also cover my bills is two. None of that is me trying to scare you. It's just where things are right now in real time as I record this. In any environment like this, discipline stops being a personal trait. It becomes armor. The people who keep investing through noise like this, who don't touch their portfolio while headlines get loud, they're building a different outcome than the people waiting for things to feel safe again. Think back to 2020. Think back to 2022. Both times, it felt like the worst possible moment to keep investing. Both times, the people who kept going came out ahead of the people who paused. And both times, there was a version of the news telling everyone to sit tight and wait for clarity first. Clarity doesn't show up on a schedule, but the time things feel obviously safe, the price have usually already moved. Things never feel safe. That's not a coincidence. That's the actual trick. Here's something to think about. Things are not going to go back to where they were. Pensions aren't coming back for most of us. A single income covering a whole household on its own is not coming back for most of us. Cheap housing near a good job is not coming back either. People spend years hoping the old rules will come back in style. That hope is a waste of the one thing you can't get back, which is time. The new playbook is the one you build yourself, starting with whatever you got right now. What discipline actually looks like today. That's the backdrop, and here's exactly what it looks like. People hear financial discipline and picture some extreme version. No coffee, no fun, spreadsheet prison. That's not it. Discipline is boring on purpose. It's deposits that go in every week, whether the market is up or down. It's not checking your portfolio 5 times a day. It's not panic selling because of one red week on the news. For me, it's very simple. Money comes in, a chunk of it goes into the portfolio, and I check the numbers once. A lot of that is automated on purpose, so the decision gets made once, and then it just runs. The fewer decisions I have to make in that moment, the fewer chances I give myself to take myself out of the plan. My blended portfolio yield is now 5.23% across SCHG, SCHD, SPYI, GPIQ, and VYMI. The numbers didn't come from any lucky pick. It came from showing up every week and not getting cute with the plan. My portfolio sits at $11,511 right now. I've got $443 borrowed against it. That covers my phone and internet bill, $203 a month combined. That's phase 2 of my bill stacking plan. It's not a huge number yet. That's the whole point. I'm not here because I've made it. I'm here because I'm doing the boring things consistently and showing you exactly what that looks like in real time, mistakes and all. Here's what a real week looks like, start to finish. Money hits my bank account on payday. I set amount to move over to my M1 automatically. M1 buys into the portfolio on its own schedule, spread across all my assets. Once a week, I open up the app, glance at the total, glance at the borrowing tab. Pretty much that's it. That's the whole secret system, not staring at charts all day. Some weeks I feel motivated and I want to check it every now and then. Some weeks I don't want to think about money at all. The system doesn't care which week it is, and that's exactly why it works. The boring version wins because it doesn't depend on how I feel that day. That's discipline on the deposit side. It gets more serious once the leverage enters the picture. I keep my loan to value around 12%. M1 margin call threshold sits at 40%. The gap does exist on purpose. On a $11,500 portfolio, 40% LTV would mean owning over $4,600 against it. Nowhere close to where I actually sit today. I keep it nowhere near the line on purpose. Not because I got lucky. If I let my borrowing creep up and the market drops hard at the same time, I could get a margin call, meaning I'd have to add more cash or the platform could sell my position for me, whether I want it or not. Staying disciplined about that gap is not optional for me. It's the difference between using leverage safely. I don't borrow more just because I technically could. That kind of resistance is exactly why the outcome looks so different from person to person. Here's something worth sitting with. EBRI looked at the Fed's own numbers on this. Their survey of consumer finances. Only 4.7% of Americans have $1 million saved in their retirement account. That number dropped to 1.8% once you're talking about 2 million. Reaching real financial security is not the norm. It's very rare. And it's rare because for the specific reason that has nothing to do with access. There was a separate study called the Dow Bar study. It tracked what the market actually returns versus the average investor actually earns. The market has historical returns somewhere around 7% to 10% a year. The average investor, according to that study, earned about 3.66%. Same market, same opportunities, completely different results. The gap isn't luck. And it isn't access to some scary fund. It's people buying high because they're excited and selling low because they're scared. Same chart, same funds. Different outcome based entirely on what people did in the moment that felt the hardest. Discipline doesn't get tested when things are easy. Everyone can invest during a good year. It gets tested when the job market turns ugly, when a friend gets laid off, when the headlines are all bad at once. That's when most people stop. They pause the deposits. They sell so they can wait it out. They treat the plan like it was optional the whole time. Picture the actual decision point. Your portfolio is down for the month. The news is calling it a correction. Your brain is telling you to stop the deposits until that calms down. That's the actual moment discipline either holds or it doesn't. The people who deposited through that month are buying a lower price without even trying. The people who pause are sitting on cash, waiting for a green light that never really comes. People who don't stop, the ones who treat discipline as a non-negotiable, those are the people who come out the other side of the rough economy with a bigger position than when they went in. So don't call it luck. That's just showing up when everything is inconsistent. Knowing that doesn't make it easier. It just raises a harder question. Where are you even supposed to learn how to do this? Let me describe a specific kind of moment. You're going along, feeling fine about money, and then something hits you. Maybe it's a bill you didn't plan for. Maybe it's watching a coworker get let go with no warning. Maybe it's opening your account and realizing the number is smaller than you thought it would be right now. Whatever it is, it stops you cold for a second. And that's the moment I mean when I say real life catches you. And here's what most people do right after the moment. They go ask somebody for advice, their parent, a friend, someone they trust. That's a completely normal instinct. But think about who's actually giving you that advice. Did that person build the thing you're trying to build? A lot of the advice that's floating around you sounds the same no matter who says it. Get a degree, get a stable job, stay there for 30 years. Debt is always bad, no expectations. Renting is throwing money away. Buy a house and the rest will take care of itself. None of that is untrue for everyone, but none of it is tailored to you either. It's the traditional path that a lot of people were handed. And for plenty of them, it never turned into real wealth. It just turned into a stable paycheck and not much else. It's just what worked or didn't work for the person saying it. A lot of that advice comes from people who never built real financial security themselves. That doesn't make them a bad person. It doesn't mean they don't care about you. It just means their advice reflects their own results, not yours. Nobody handed them a real plan, so they can't hand you one either. They're doing their best with what they were given, same as everyone else, which means the plan has to be yours, not because nobody cares about you, because no one else is in the position to build it for you. Being disciplined starts with accepting that part. You're not being selfish by taking your own money seriously. You're doing the one thing that nobody else can do for you. For me, building my own plan isn't abstract. It's an actual spreadsheet with actual phases and actual dollar targets, and I check it against reality every day. It doesn't have to be fancy. It just has to be your own written down with numbers you actually check. That's the difference between hoping it works out and knowing exactly where you stand. Breaking the pattern once on purpose, and it stops being the family default. It becomes something the next person after you gets to inherit instead of just guessing at. Building your own plan solves one problem. Timing is the other one, and it matters more than people think. Just know that tomorrow is not promised. That's not being dramatic. It's just true. But here's how people misuse that fact. They hear that life is short and use it as a reason to spend everything now and deal with the money later. That's backwards. The truth actually cuts the other way. Because life is short, you don't have room to keep pushing this later. Later has a cost. The cost is time. The one thing compounding actually needs to work. Here's what that looks like in real numbers. Say you invest $200 a month at a 7% average annual return, starting at 25. By 65, that turns into a roughly $500,025. Now push that plan back at age 45, the same $200 a month, same 7%, just 20 years later, now you're talking $140,000. Same amount of money in, same rate of return, one choice 20 years apart, and the outcome is 5 times smaller. That gap isn't from investing more. It's purely from starting early, and it works the same way inside a plan like mine. The earlier the phase gets unlocked, the sooner the next one starts compounding on top of it. Phase 2 starts today, makes phase 3 easier to reach. Skip a year at the start, and every phase after that gets pushed back. It's not just about the money you're missing depositing that year. It's about the growth that the money never got the chance to earn on top of itself. Most people in their 20s and 30s assume they've got plenty of time to start. Ask anyone older than you what happened in their 20s and 30s, and most of them will tell you the same thing. It went faster than they expected. This isn't about fear. Live your life. Enjoy it. Just don't confuse enjoying your life with ignoring your future, because those are two different things wearing the same excuse. You can do both starting today with whatever amount you've actually got. Even $50 a month started today beats a perfect plan you launch 5 years from now. To put all this together, and here's the actual takeaway. So when I say financial discipline is God mode, I mean it in a boring way. It's not about intensity. It's about not quitting on the plan when the plan stops feeling exciting. That's the whole cheat code. Nobody's coming to build this for you, and nobody's coming to stop you either. The Fed's decision on the 28th, the rate on my loan, the up and downs of SCHD, none of that is the deciding factor. The deciding factor is whether I show up again next week the same way I did this week. If you're building something right now, stick with it, especially right now with rates uncertain and the headlines are loud. Hit subscribe if you want to see this get built in real time, numbers and all. Thank you for watching, and I will see you on the next one.